Rental property rent-to-value ratios are down. Is the cash flow gone? Where in the heck are all the deals anymore? So let's discuss how you can discover a profitable rental property today here in this environment where real estate prices are up some 20% year over year and rents are spiking too. Hi, I'm Keith Weinhold. This is Get Rich Education. Now, first of all, say back 10 or more years ago, it was quite possible for you to find a rental property, call it a rental single-family home, where the monthly rent income was $1,500 and the total purchase price was $150,000. That ratio, the monthly rent to the purchase price, is known as the RV ratio. Well, that 1% rent to value ratio, that was seen as a good deal and desirable. One needs to remember that only compares two numbers, so the RV ratio is just a general rule of thumb. It's really just the top line, and your cash flow, running all the numbers, is the bottom line. Today, a property can be equally profitable to you at a substantially lower RV ratio, say as low as about 2/3 of 1%. Now, how could that be true? Would one be letting their deal standards slide? And how could something like that change so much? Well, there are actually three reasons why substantially lower rent-to-value ratios work today. And I think the first and the most easily understood one is the effect of low mortgage interest rates. Mortgage interest rates are about half of what they were in 2008. And with the way that you and most people buy a property, 75 to 80% of the purchase price of that property is tied to the mortgage interest rate. Now we're going to look at a sample property in just a moment so that you can see exactly what I'm talking about and some of the reasons why substantially lower rent-to-value ratios work today. You've got these historically high home prices, these historically low mortgage interest rates, and you also have spiking rents. Hey, go ahead and put a YouTube like on this if you would, how we're really getting into it and kind of breaking down the science and the math of what makes a profitable property today and how that's changed it over time. I'd really appreciate the like. Let's go ahead and jump into this sample property here. We'll use a rent-to-value ratio that's substantially lower than 1%. We'll use 1/3 of 1% here, 0.75, and we're going to see how much cash flow this property generates. So the purchase price is $250,000. We'll call this a rental single-family home. That rent of $1,875, that is 3/4 of 1% of the purchase price. And your principal and interest is going to be $955. That's a $200K loan, meaning you're putting 20% down and taking out an 80% loan at a 4% interest rate. And you can see your vacancy. Vacancies are really historically low. Your insurance, your maintenance at 8%, property tax, utilities, and management. I like to remember those 6 operating expenses with the acronym VIMTUM, VIMTUM, as you probably know. All right, so your rent income minus your principal, interest, and all those operating expenses equals a cash flow of $129. All right, pretty safely, pretty comfortably on the positive side. And you do want your cash flow to equal a positive number before you buy. You want to project that out to be a positive number. And it's pretty comfortably positive right here. So this shows you that the rent-to-value ratio is only the top line in you making a purchase determination. The cash flow is that bottom line. Now, I mentioned there are 3 main reasons for substantially lower rent-to-value ratios work today. I discussed interest rates, but this low RV ratio of 0.75, that provides cash flow for a couple other reasons. There are things that are going on in the rental market today that weren't happening 10 years ago. So the second reason that lower RV ratios work today is today there are way more what they call build-to-rent properties, brand new properties built with a tenant in mind and an investor owning those on day one. And I'll show you by the end of the video how you can get a hold of some of those actual properties. Yeah, you didn't see so many of those 10 years ago. And today, these new build, the build-to-rent properties, they seem even more common than renovated income properties. Now you might wonder, well, what do new build properties have to do with the rent-to-value ratio? This is because new build properties, brand new construction, they typically hold on to occupants a really long time, especially that initial occupant. It's so desirable to live in a place that's new and has all these amenities, and no one wants to leave that condition once they have that very quickly. So you have a lower vacancy rate with new build properties. You also tend to have lower insurance costs. and you have lower maintenance costs with new build properties. Everything's brand new. So RV ratios also do not account for these things in new build properties: lower vacancy, lower insurance, and lower maintenance costs. Now, the third reason why substantially lower RV ratios work today, and this is whether it's either new or renovated properties, is really GRE's formula here, which is often to have you not hold on to a property for much more than 8 years, depending on appreciation rates. Typically, after that 8-year mark or so, you want to sell that property and trade up for a larger property. Now, why in the heck would you ever sell a cash flowing property? What's better than that? Well, what's better than that is a bigger cash flowing property, because often what happens over the years, just long term and historically, it doesn't always happen, but in an 8-year cycle, you're going to have appreciation such that you might have half equity in that property. Now that the property is so equity heavy, your total rate of return gets watered down because the return from home equity is always zero. So consequently, when you avoid these long hold times, what you do is you hedge yourself against these long-term expenses, or what are known as Capex, capital expenditures. For example, you're likely never going to have to replace a gas-powered hot water heater, which has a life expectancy of something like 10 years. Many times, you're going to sell it before that happens. So this is really just a byproduct of you harvesting out your equity by selling the property. Equity harvesting keeps your leverage ratio and your total rate of return high. So really, this is why an educated GRE buyer is more profitable than other buyers over the long term. Now, if you happen to have a star performer property in your portfolio, okay, well, maybe you will hold that for substantially longer than 8 years. But even then, you can hold on to the property and extract a big chunk of the equity out completely tax-free, because the IRS identifies that as debt and they don't have any tax obligation related to this debt that you've taken out. But you're still going to have to leave some protective equity in there, maybe as much as 30% for a lender to want to let you do a cash-out refinance if that's available at all. And with a cash out refinance, you cannot get as much cash out of it than you could if you sell it, of course. If you sell it, you actually get all of the cash out. So these are reasons why rent-to-value ratios of substantially lower than 1% still work today, maybe even something down to about 2/3 of 1%. Hey, go ahead and put a like on this if you think you learned something. You've got to like the fact that you can still find cash flow in the United States today, although it is more difficult than it used to be just because the overall amount of property inventory is substantially down, but there is cash flow out there. And really what we've been talking about here, this is something real. This is something that ought to make some sense to you. We're not being speculative and saying, well, it's a good idea to buy property because we think that the prices are going to keep going up or that rents are going to continue to climb. We're keeping that completely out of this. We're talking about knowns, not hopes. And remember, let's keep this whole RV ratio and even cash flow within some context here. A property with a RV ratio of 0.7% might actually be better than a property with a full 1% RV ratio. And how could that possibly be true? Well, that's because the property with a lower RV ratio, maybe you're buying that in a market that has a lot of job growth and population growth and has a communicative manager that you can trust in that market, where things are sketchy in a tougher neighborhood over there with the full 1% RV ratio property. So in summary, there are 3 reasons why lower RV ratios work today, maybe even down to around 2/3 of 1%, depending on the deal. The first reason is historically low mortgage rates. The second reason is more new build properties. And the third reason is oftentimes you're not holding for much more than 8 years, hedging you against layouts for long-term maintenance and Capex expenses. The RV ratio matters, but because it's so simple, you've got to look at more in making a purchase decision. So I promised you I would help you out. For you to connect with the best income property providers in the nation, register at our sister website, gremarketplace.com. Life-Changing.com. This is the same resource I use for buying my own properties. You can go there and connect with providers in the best U.S. markets. Oftentimes they tend to be in the United States Midwest and South. That's where you tend to get the best, most profitable properties. You can learn about what properties you can buy there. Oftentimes you're going to find single-family rental homes, sometimes up to fourplexes and larger. And Andrea here at GRE, she went ahead and interviewed all of the property managers in these markets, and we have the video for you in there too, since you want to get a feel for the property manager, because hey, they're the glue that makes this stick together for you. They're the ones that actually make this pretty passive for you. Knowledge is not really power unless you go ahead and take that knowledge and convert it into some action and own some cash flowing property. Check out gremarketplace.com. You can register and get started there. I'm Keith Weinhold. Thanks for being here, but you weren't here for me. You were here for you. I'll see you in the next video.